In this video, I will be looking at how different hedging strategies have performed over different time periods and how you can use this information to maximize the potential of your portfolio. This is Mark from TradeInform.com, and this is the third video in a three-part series to ensure that your portfolio thrives no matter what the markets do. If you would like to watch the first video in this series, there is a link on the screen and below this video, and you can see how I have set up this test. In this video, I'm going to be looking at different time periods. I'm going to be looking at how a walkthrough analysis can make a difference in how we hedge our portfolio. On the screen at the moment, I'm showing the results of a hedged portfolio. This is the Spider ETF from 1993 to 2018, and I am hedging it with the linear regression. And I am simply using a 200 period linear regression. I am always in the market when the linear regression is pointing upwards, and always out of the market when the linear regression is pointing downwards. So I have a hedged portfolio here that has performed very nicely. It has a compound annual growth rate of 10%, and that is greater than the compound annual growth rate of the overall market. However, we've got before us here a very large increase in the market. At the moment we're at the tail end of 2018. We've already seen a market fall. We've already seen volatility. We've all read articles about protecting yourself from a market crash, diversification and hedging. What I want to know is how have these hedging strategies performed in similar time periods over the past 25 years? So I'm going to do this using a walkthrough analysis, and I'm going to look at how the strategies have performed at different time periods. Now, the first time period I'm going to select is 2000, and I quite like using 2000 as a base year because we've got a rocky period. We've shown that the market can go up and down over the last 18 years. I'm going to go back onto buy and hold. And we can see that over this time period, over the past 18 years, with dividends reinvested, the Spider has returned 4.1%, which is not a great return over this time period. However, this is the reality of two significant bear markets. We can have a look at how the different hedging strategies have worked. We can see that the EMA, the below the moving average strategy, has given us a much lower drawdown and a slightly lower compound annual growth rate. The golden cross hedging strategy and the linear regression strategy, both of which were described in video 2. And if you'd like to watch that video, there is a link on the screen at the moment. And we can see that both of these have performed somewhere slightly better than buy and hold. In particular, we've got a compound annual growth rate of around 5%, but much lower drawdown. So 2000 was just at the beginning of the slow dot-com market crash, a significant bear market that took about 6 years for market prices to recover. Now, the next time period that I'm going to look at is 2007. Many people will remember the financial crisis and the significant stock market fall that occurred after that. Once again, I'm going to go back to buy and hold. And we can see that if we had bought and hold in 2007, we can expect annual growth rate compounded of 3.5%. And we have this large 55% loss of capital to deal with first. If psychologically we've been able to deal with this significant fall and then the extended recovery time needed to prices to get up to where they were before, then we could have reaped the rewards later on. Now, if I compare this to our three other hedging strategies, we can see once again Selling below the moving average has performed slightly worse, but given us significantly lower drawdown. The golden cross has given us a similar level of compound annual growth rate, but once again, even lower drawdown. And finally, the linear regression has returned pretty similar results, but slightly lower drawdown. And we can zoom in here, we can see that it's kept us out of the market during the worst of the financial crisis, and it's taken us out at a couple of periods here. This one, we can see that the markets faked to go lower, but in fact they rose up much higher again, and it's taken us out of that as well. So we can see that the hedging has performed well in the two significant corrections of most of our trading and investing life, the 2001 bear market and the financial crisis bear market. As a final test, we can look at how our strategies have performed if we'd timed everything perfectly. If we'd bought at the very bottom of the financial crisis sometime in 2003, we could expect a compound annual growth rate on a buy and hold of something around 6%. But we still have this large drawdown. The only time that we could have avoided any significant drawdown is to buy here, is to buy in early 2009, in which case we would have timed it perfectly and didn't need to worry. If we are getting any form of bear market, significant market correction in the future, the results using the SPY over the past 25 years show that it is better to be hedged, both psychologically and in terms of capital accumulation over the long term. These results that I presented here refer to the SPY ETF, but you might wonder, if you trade a different market, how they relate to the markets that you actually trade. Well, this spreadsheet is available on tradeinformed.com, and you can use this spreadsheet on all sorts of different markets, stocks, indices, and any other markets that you would like to. There is a link on the screen and below this video for you to find out more information about that. And if you like this video, please hit the like button. If you want more content like this, please hit the subscribe button. And for more information about trading the financial markets, in particular how to analyze your trading strategies, please go to www.tradeinformed.com.